This podcast is based on publicly available information and is intended for educational purposes only. Today's episode is about one of the most recognized fintech brands in India. It processed billions of transactions before most Indians even trusted digital payments. And yet, despite massive scale, this company struggled for years to convert usage into profits. This is the story of Paytm and what happens when scale arrives before a sustainable business model. Paytm was founded in the year 2010 by Vijay Shekhar Sharma under 197 Communications. They started as a fintech solution to simplify everyday digital payments in India. India at that time had a low card penetration. That is, the credit and the debit cards were not widely used, especially outside metro cities. We had cash-heavy transactions. Most of the daily payments were dependent on physical cash only. Limited trust in online payments. People were hesitant to store money or transact digitally. So the Paytm focused on prepaid wallets. They allowed the users to load money digitally without using cards every time. Mobile recharge, a high-frequency use case that encourages repeat app usage. And utility payments. This solved real and recurring problems like electricity and phone bills. So the real achievement wasn't technology. It was behavior change. Paytm changed how Indians thought about money, and not just how they paid. Paytm trained users to pay digitally, shift from cash to QR codes and app-based payments, store money in wallets. This increased stickiness and repeat usage. Trust QR-based transaction. This actually made small merchants and users comfortable with digital payments. This trust layer became their strongest asset. Even when profits were low, users' trust kept the Paytm relevant and widely used. So in the year 2016, demonetization created a sudden cash shortage. Paytm responded immediately with QR codes everywhere, zero-cost onboarding for merchants, and aggressive marketing. Millions of small merchants adopted Paytm without even understanding the alternatives. This created a massive user base, dense merchant network, and first-mover advantage in QR payments. However, this growth was rapid and external policy-driven. So now let's look into the core reality. The payments are low-margin business. What's this actually? So the issue is built into the business model, not caused by bad execution. In India, payments ecosystem is tightly regulated by policy and RBI rules. UPI transaction have near zero merchant fees. That is, the merchants are not charged much. So platforms earn almost nothing per transaction. Wallet margin are capped. Paytm cannot freely increase fees to improve profitability. Interchange revenue is limited by regulation, which means revenue shared between banks and the platform is restricted by rules. So even at huge volumes, that is like when they make more transactions, they don't gain more profit. Scale increased usage, not the margin. Payments became a distributional channel. That is, the payments help acquire and retain users, not a revenue engine. The payments alone couldn't generate them a meaningful profits. Paytm's scale was impressive. User base, merchant reach, and transaction volume were massive. Its margins were not. That is, like profit per transaction remained extremely low. To solve this, Paytm expanded aggressively. They moved into lending, consumer and merchant loans, insurance distribution, wealth management, ticketing and commerce. Last but not the least, banking. So the logic was simple and basic. Use payments to cross-sell higher margin financial products. The problem was, each vertical required different capabilities. Lending required credit discipline, banking required strict compliance, and insurance required advisory trust. Paytm was managing too many regulated businesses at once. Fintech operates under evolving regulation. Paytm faced regulatory scrutiny around its payments bank, compliance cost, capital adequacy requirements, and operational complexity across verticals. As regulation tightened, the cost also increased. This exposed to weak unit economics, dependency on continuous funding, fragile margins. So the scale increased complexity faster than profits. Now let's look into the IPO, when the private logic met the public markets. Paytm's 2021 IPO was a turning point. Why? Because the public market asked, when do you make more money? Which vertical is profitable? What is the path to sustainable margins? The valuation narrative shifted from largest fintech platform to profitable fintech business. The stock corrected sharply. This wasn't a rejection of Paytm. It was a reset of expectations. Post the IPO, Paytm began adjusting. They reduced their cashbacks, forced on contribution margins, they prioritized lending profitability, cut the operating cost, and simplified offerings. So the company just moved from expansion mode to efficiency mode. Survival replaced domination. Here's the deeper lesson from Paytm. Distribution is power, but economics decide endurance. Owning users is not enough. You must own a profitable reason to serve them. That was Paytm, scale before profits. The next episode is about Nike, brand over manufacturing. This is Shruti signing off. See you in the next episode of One Company, One Story.